Hey y'all, welcome back. We are going to be doing lecture 17 over chapter 7.7, stocks and bonds. So the first thing we're going to do is run through these definitions. A stock gives you a share of ownership of the company. You invest by purchasing shares. The only way out is to sell your shares. A bond kind of represents a promise of future cash. The issuer pays you simple interest and promises to pay back your initial investment. And a mutual fund is a kind of investment that uses money from multiple investors, sometimes referred to as a pool, to invest in stocks or bonds. So our first example is going to be this stock listing here. We are going to use the stock listing to answer the following questions. So first you want to know what is the current price of the stock and what are the shareholders currently trying to sell it for. So if we scroll back up, we can see that the current price of the stock is going to be near the top of the listing. It's going to be the $87.27. Right here up at the top. And then shareholders, so this is the current price. And then we need to figure out what the shareholders are asking. So again, we scroll back up and we see right here where it says ask. So it's going to be how much the shareholders are asking for it. That's going to be that 8707. All right, number 2. What do analysts predict the price will be in 1 year? So if we again scroll back up, we can see that there is a 1-year target estimation price, which is going to be that 111.75. So this is just 111.75. Next, we want to find out, is the stock more or less volatile than the market as a whole, and how do we know? So we'll go back up, looking up here. How we find that out is we look at this row here that says beta. And essentially the trick is less than 1 means more stable. So we would just say it's more stable. All right, number 4. What is the highest stock price in the last 52 weeks? Again, we're scrolling back up and we're going to look over here where it says 52-week range. So it says it's gone from $70.32 up to $99.24. So that means the highest price is going to be $99.24. Number 5, does Facebook pay a dividend to shareholders? What do you know? We're going to scroll back up and we are going to look for the column that says dividend. It's actually abbreviated. So this is the dividend. And it says NA, which means no, they do not. So no, Facebook does not pay. Last, use the market cap to find out how many shares the company has issued. So the market cap is going to be the total value of all of the shares. It's right up here, again on our chart, 245.89 billion. So we've got first 245.89 billion. And then we want to divide it by the current price of the shares. So it's divided by $87.27 from number 1, the current price of our shares. And that's going to be equal to about 2.82 billion shares. And that's it. So stock problems are essentially just reading the chart. All right, annual earnings per share. So the formula for annual earnings per share is going to be yesterday's closing price divided by the PE ratio. So our example is on February 17th, 2017, T-Mobile stock closed at $63.92 per share. And the PE ratio is listed as 38.05. What were the earnings per share for last year? So we'll use our formula. So annual earnings per share, I'm just going to put earnings just for shorthand, is going to be equal to, now our price was, so stock closed at $63.92. So that's going to be our like closing price from yesterday, essentially. So we'll have $63.92 on the top, divided by the PE ratio, which is given 3805. And that's going to be approximately $1.68 earnings per share. All right, and that's it. So let's keep moving on. Okay, so next we're going to talk about bonds. So our girl Ellen buys a bond with a face value of $1,000 that was originally issued 30 months ago. The maturity date is 4 years from the time it was issued, and the interest rate is 4% simple interest per year. If she pays $820 for the bond and keeps it until the maturity date, what's her profit, and what percent return does she get per year? Alrighty. So what we're going to do first is use the simple interest formula to find the value of the bond at maturity. So remember, simple interest is I equals PRT. And then our principal, whenever we're dealing with bonds, our principal is going to be the face value. So it's going to be our principal. Our rate over here is 4%. And then our time is 4 years because that's the maturity date of the bond. So we're going to have I equals 1,000 times 0.04 times 4, which is equal to $160. And that's not the answer, but we will need to remember this number. So after drawing $160 in interest, the value of the bond is going to be the 1,000, which is the face value, plus the 160. So our new value of the bond is going to be $1,160 since it has gained $160 in interest after the 4 years. So Ellen paid $820 for this bond. So that means her profit is going to be how much she's getting from it, which is the $1,160, minus how much she paid for it, which was the $820. So she's going to gain $340. Next, we want to figure out her percent return that she's going to get per year. So what we're going to do first is figure out her overall percent return. So overall percent return, all we're going to do is take her gain, which was the 340, and divide it by how much she paid, which is 820. So that's going to be 0.415, which you then convert to a 41.5% gain on her investment. So she put in 820, 41.5% of that is 340. However, this is overall, and we want her yearly gain. So if we want her like yearly gain, we know she needs to wait 18 months or 1.5 years to cash in the bond. So that means we'll have that 41.5%. Oh, so I'm sorry, this is the yearly. Divided by 1.5, because that's how many years she's waiting. So this is going to equal to 27.7% gain per year on the investment. And that's it. That's the whole lecture. So thank y'all for tuning in, and I hope y'all have a fantastic rest of your day.